Welcome, everybody. We are super excited today for today's webinar. I'm Carl Holman, Manager of Communications here at A&D Mortgage. And today we are joined by a very distinguished panel for our Experts Roundtable. And we're going to discuss where the non-QM industry is headed this year. Couple quick housekeeping things. I ask that everybody turn their cell phone off so that you can be focused on the content that we're going to be talking about. There's going to be a lot of good content coming. During the course of the webinar, there'll be a couple of polls that'll pop up that it'd be interesting for you guys to participate. I think we've got 4 or 5 questions, a little bit about the non-QM industry and other things about whether you're working with us currently. So with that, and just for those people who arrive, we are recording this, so everyone will get a copy of the recording. We'll send it out either before the end of the day if it finishes processing, or you'll get it first thing tomorrow. And we can give you a copy of the presentation, but there won't be much of one. So with that, let me go ahead and introduce our moderator for today, Rob Chrisman, one of the most well-known people in the industry. So Mr. Chrisman, go ahead and take it away.
Well, thank you, Carl. I don't know if I am one of the most well-known, but thank you for that. Yeah, there's so much going on with both the QM and the non-QM industries, and how non-QM especially can really help homeowners. And I think the industry looks to non-QM and some of the programs, for example, self-employed and so on, that can really boost a company's bottom lines. And I think that's what a lot of people are tuning into here and find out, gee, non-QM, what does it really mean? How can I use it? What is the technology? What are the trends? Really, how can I use this to help my borrowers or help my company? And you're right, we do have a very good panel. And you introduced yourself, and yeah, my name is Rob Chrisman, and I'm an old capital markets guy. A lot of people know me from my daily commentary that I send out, but my background is capital markets since about 1985, 86. But I am going to let the panelists introduce themselves, starting with Max. If you could take it away, Max, tell us a little bit about yourself and what the heck are you doing on this panel?
Yes, Rob, thank you. Appreciate that. And I'm glad to be here with you and with all the panelists. I think we're going to have a lot of fun. I'm Max Slusarchuk, CEO of A&D Mortgage. And Carl asked me to give a few minutes about us, what we do. I'll try to take 30 seconds. We are Fannie Freddie seller servicer, and we are a non-QM direct market participant, the securitizer. We do our own guidelines and we securitize our own papers. So we are the one that called, investor. We are an aggregator, would say. We service all our loans, either it's conforming or non-QM. And we've been doing this since 2005. We've been through all the rating agency approvals and all the capital market guys working with us. So interestingly enough, our mix of products is still more in non-QM side. We do more non-QM than conventional, but at this stage at the economy, we are trying to work with all our partners to help them with everything we got. We do not have overlays on conventional loans, so whatever we can help with conventional business as well, we are trying to do. We have like over 5,000 broker partners, and we're trying to work with every one of them. I think that's enough of introduction, Rob.
5,000. Holy smokes. All right. Well, thank you very much for that. And Carl, did you say there was some recent news about Nevada?
Yeah, we recently just got our state licensing in Nevada, so we keep expanding our footprint nationwide.
Very good. Very good. Alex, tell us about yourself.
Hello, everyone. Pleasure to be part of this webinar. Carl, Rob, thank you so much for putting this together and bringing us all here. I run capital markets at A&D Mortgage. Work closely with Max and Billy. On a capital market side, we are managing interest rate risk for the portfolio of mortgages that A&D has. We're managing the portfolio of the mortgages itself, whether those are going into securitization, or we're selling whole loans to investors or to the agencies. And also capital markets is working on the product development side for A&D, introducing new products, developing some additions to our current non-QM programs. So whether it is going to second mortgages or jumbo production, that is something that capital markets is working on, as well as obviously the economic part of the execution and the current interest rates pricing for A&D. Thank you. Back to you, Rob.
And Alex, where are you today?
I'm located in Hollywood, Florida, as well.
I think we have a worldwide crowd on the phone here. Max, where are you?
Yeah, I'm in Hollywood. We are in the same office with Alex. We are in our headquarters in Florida.
Okay. All right.
Max is on the east side, and I'm a little towards the west part of the building.
Very good. And Billy, where are you today?
Billy's on the south side of the building, and so geographically we got it covered.
You're all over the building, and there in Florida. Billy, tell us about yourself.
Well, Billy Abrams' the name. I'm the president and CEO of ADM Securities, which is a sister firm of A&D Mortgage. I also do business development work for AD. Began my career in a commodities business, a commodities broker. Within about a year and a half, I moved over to institutional fixed income securities. So since we've been in the bond business for the better part of 4 decades, I've worked in management, trading, sales. And on the sales part, I spent part of the time helping originators hedge their pipelines with TBAs, which is where, how, and when I met Max. I'm a market technician by passion. Almost every day for more decades than I care to remember, I've written a market update, technical update covering treasury markets, which I still do for A&D Mortgage. And then some of you probably know me from the videos I do with Alex on Fridays, and that's about it. My background, kind of like you, Rob, is more capital market side than it is on the lending, but I learned my way through.
Very good. Yeah, capital markets people used to, like, they'd go to class in elementary school down by the boiler room. You know, we were always like, oh, those are those guys. So we'll wrap up here with Derek. Derek, where are you today?
I'm actually on the line or on the call from all the way down in Melbourne, Australia. Okay. And if you're wondering about the darkness in the background here, that's because it's 5 a.m. in the morning. So it's a pleasure to be here with each of you guys, and a pleasure to meet you. And to give you a quick summary about what I do, I'm basically a social media coach specializing in LinkedIn, Facebook, and Instagram. And I work with mortgage brokers, loan officers, realtors, real estate agents, and the people in the B2B field. So that's my area of specialty, and it's great to be here.
And I know we're going to talk later in the session to you, but specifically if a broker needed help with social media or had a question about that topic, they could go to A&D and you would get looped into that discussion perhaps?
Absolutely, or just reach out to me on LinkedIn. Just look for Derek Mildred on LinkedIn and reach out. Send me a personalized request to connect message. In other words, give me a message that tells me where you're from, and happy to talk to you further and help.
Very good. I should join up with that LinkedIn thing. I've missed the boat on that.
It's still growing.
Well, welcome everybody. And I thought I would kind of throw this open to the group because it is such an issue with regard to probably everybody listening in and watching, and that is this housing market. Rates are going to do what rates are going to do, and we don't have a lot of control over that. And we will be talking about rates here in a little bit, but the housing market is a concern for everybody. And if there are too many homes obviously up for sale, the price goes down. If there are not enough home for sale, the price goes up. And inventory levels have been a concern for some time now. That's potentially normalizing somewhat. But I wanted to ask anybody who would like to chime in about the housing market in terms of trends that they're seeing out there among your clients, among the broker clients for A&D, new home sales, existing home sales, and so forth. And maybe we'll start. Actually, I'm not going to throw it open to the group. I'm going to throw it open to Max right off the bat. Max, you have your finger on the pulse of housing markets around the nation. What are you seeing out there to give maybe some optimism to where things are now?
Max, you're muted.
Sorry, yeah, thank you. And as we all understand that once rates go up, the property value started experiencing a little bit of an issue like we've seen before. But what we see today, what we see right now, the property values are not dropping that much as everybody would expect this to be a disaster. It's fine, everything is holding on. Of course, we see a little bit of a fluctuation, a tiny market correction on the West Coast, maybe a little more than the East Coast, but surprisingly enough, property values are holding on real well. And we would like to continue seeing that. We, of course, no one in the industry wants the property values going down, and our government doesn't want it. That's why we believe that the step ups, next two step ups that Federal Reserve will do are going to be a quarter and then a quarter, which is less. They see that inflation is tapping out and they're going to slow this down. So we do see a little market correction. We see that properties stopped like going up crazy in values, but we do not see disaster. We do not see panic. We do not see any fire sale. There was during the pandemic times, there was still shortage of there was a shortage of materials, supplies, and everything else, and this shortage accumulated a little bit, right? So for a year and a half, almost to 2 years, there was not a lot of new homes coming up. So we still experiencing, as of today, a little shortage here and there. And I think that's one of the factors that contributing to the stronger pricing hold up given the situation. So both of these combinations, slowing down the rate hikes, pulling a lot of money inside the system at the pandemic, given the shortage of housing during the pandemic time, because the situation playing the big role of the grip of the home prices. So we're pretty happy to see that.
Yeah, there's a and Alex, any thoughts?
Yeah, to add a little bit to Max's point, even though we see that the property values, the housing price index has appreciated about 1.4 times since the pre-COVID levels, the RMBS for the research from one of the rating agencies, which is Fitch for home prices, shows that currently nationwide the property values are overvalued only about 5 to 10% on average from where they're supposed to be, with Florida being at 6.5%, California a little higher at 80%, and the highest overvalued MSA apparently is Buffalo in New York, which is a little over 10%, closer to 15%. But with all this being said, it shows that the overvaluation of the properties is not crazy and is subject to a slight correction, which is typical and cyclical, right? But as Max said, there is no crazy overvaluation for the properties as we see today.
It seemed like if you go back historically and look at the normal levels of appreciation, 2%, 3%, 5%, whatever it might be, 20%, and I'm rounding these numbers dramatically, but 20% in 2020 and then another 20% in 2021, that's basically unsustainable and not healthy for the housing market, especially in terms of affordability for first-time home buyers who are just watching people who own homes do very well from a balance sheet / wealth perspective, but they, a year or two goes on, and they have even more trouble, getting on the housing merry-go-round. And I wanted to ask you guys, in terms of affordability and so forth, non-QM is viewed as a way for borrowers to be able to find a program that really fits them. And but there are other things that lenders are doing that can increase the affordability for their clients, and different programs and so forth. Would anybody like to address the question about how lenders out there and brokers can increase affordability for their clients?
Well, I can try that. Well, with interest rates are going up from 2.5 to 6.5 on conforming paper, it is obvious that less people will qualify, right? With the income didn't triple in 6 months, right? So it's just interest rate tripled in 6 months. So what happens that less people will qualify for conventional way of income documentation, meaning the tax returns and pay stubs. So self-employed guys and business people will have to look somewhere else if they still want the property. We understand that with higher rates, there are less buyers for the properties in any case. But if you still want to buy and you don't qualify, there's an alternative way. If you business owner, you can try to see if you qualify with your business bank statements, personal bank statements, asset depletion, DSCR for investment. So there are other ways. And the interesting thing that we are doing all we can, and I know not only us, all our competitors as well, who are in non-QM space, trying to give more education, more clarity to brokers, and trying to help the brokers how to spot these loans. Because once you tailored to just looking at conforming loan with pay stub and W-2, and you don't know non-QM product, you just can't spot that person. You say, oh, I can't help you. But there is not enough mechanism, not enough tools that brokers have to understand, can it be done or not? So we are trying to help as much as we can. And of course, we're building AUS where, today you always can run DU, but for non-QM, it's harder. We are building AUS, where we can provide our broker partner an ability to go in, run the loan, and there you go. Real conditions, real stuff. It's not the qualifier. We have qualifier on our website for last 5 years, but that's not it. We want the person to upload a 1003 and credit report and run really and see the conditions to see if I can satisfy them or not. That's real AUS. That's what we're working on. And once we will have that, and we will have this certainty for a loan officer how to exactly go about each condition, then we will see increase, and we will see a different position. But in any case, we do believe that non-QM is the answer and way to go, and for conforming guys to look to that side and say, hey, if you don't qualify, there is something can be done in non-QM here. That's an alternative. Can be slightly more expensive, but you can always refinance later. So
very good. When people talk about non-QM, they talk about the future of non-QM, and they certainly talk about certain portions of the non-QM world. terms of self-employed borrowers and so on. And I wanted to ask Alex, one topic that has come up is with regard to short-term rentals, and as a segment of the non-QM world. Can you tell the audience, can you tell the audience a little bit about that topic and about what A&D is doing in terms of offering that product?
Absolutely, Rob. Thanks for the question. Short-term rentals has been a hot subject in the past year or so, and we've been doing our research of the short-term rental space for the past year and a half, starting in 2021. We actually see an increase in the United States of people who are going for vacation or for business trips, renting out places from the platforms like Airbnb and VRBO versus using the hotels. Especially with the COVID measures and the restrictions in the hotels that became very popular, and people stick to it. And it is very easy to find a property anywhere in the United States and get it rented. We see also, which is a public information, in the Airbnb financial reports, which they file with SEC, that their the number of nights that were booked through Airbnb has increased year over year 25%, and since even pre-COVID levels, it's up about 20% on a monthly and on a yearly basis. So this proves the idea and the fact that people in the United States start using Airbnb and VRBO more and more. And we see a large demand from our investors, and actually the purpose of their investment in the property is to use that house or an apartment to rent on the short-term basis for vacation rentals. That was why we started looking at it. And of course, there are some regulations from a particular counties and cities. Like in New York, you have some limitations on how to properly rent properties on the Airbnb. There are certain limitations on the minimum and maximum number of days. Sometimes the host may even be required to stay in the property. So there are those nitty and gritty details which we are always in compliance with, and making sure that our borrower is well aware of how to rent the property in their area. And we're offering them a possibility to qualify their property on based on the short-term rent versus long-term rent, and they can do it in two ways. First would be to provide their actual statements if it is a refinance transaction, or in rare cases that may be a purchase transaction where the seller would be willing to share their short-term rental on a short-term rental income on the property, and they would provide the statements from for the past 12 months from one of the platforms. Or if it's a purchase transaction where a borrower is just acquiring a new property and wants to put it on the market, there is such platform called AirDNA, which basically links through API to platforms like Airbnb and VRBO, and they have access to the data, how many properties were rented in the past year in that area, what is their vacation rate. They see each and every property, and based on that they may have projections for the future, what this particular property in the area with, let's say, 3 bedrooms and 2 bathrooms for 6 guests would be generating, and what the vacancy ratio that would be, whether it is located somewhere in Florida or in Colorado with peak seasons, or only during winter. So that is being factored in there. You see the vacation ratio, how much it can generate, and based on that number, A&D qualifies the property. Of course, also adjusting for additional expenses that occur during the short-term rent?
So, one overriding thing that all mortgage companies have in common, and we talk about that, and that's a great explanation of the short-term rental market and so forth, and how A&D can help brokers out there when they have borrowers who come in and want to borrow for something like that. But one of the overriding things, obviously, is the current interest rate environment. And when I started in this business, Thursday afternoons, money supply would be announced, and everybody watched money supply. That has changed. Then it's shifted to the unemployment data that came out the first month of every or the first Friday of every month. And lately, for the last year or two or five, I've lost track, but all eyes are on the Federal Reserve, whether you're a non-QM lender or broker or a mortgage bank or a bank or credit union, whatever. Everybody kind of watches the Fed and takes their cues from them. I wanted to ask Billy, since this is your specialty, with Fed funds having been very, very low throughout the pandemic, and then the Fed was kind of playing catch up, and they raised Fed funds. Now there's, the financial press is consumed with making guesses about the federal funds rate, even though the federal funds rate isn't a 30-year mortgage rate. People still want to know what the Fed is going to do. And Billy, I wanted to ask you what you thought about the Fed funds environment and kind of where we go from here.
Sure, Rob. First of all, you made me laugh. I hadn't thought about M1, M2 in a long, long time, but yeah, every Thursday there was a betting pool in the office just to see who could come closest. Those were the days. So here's my outlook on the Fed. It's been several FOMC meetings, so probably 3 months ago or more than that, maybe, when Fed Chairman Powell told us that, number one, that they were about to start reducing the pace of their rate increases. And also that they knew that the impact of rate hikes on inflation was a lagging. So that they were going to reach a point where they would pause and hold rates steady. And then not only watch and see that they put an end to inflation, but it wasn't going to start back. And so they pretty much done that. The next meeting, I think, they had done a series of 75 basis point hikes. The next meeting, they went to 50. And now Fed funds stand at 450, and I think consensus is next week they're going to go 25 basis points and put it at 475. I go back and so CPI peaked in July at 9.1%. And since then, it's come down 6 consecutive months. I had some data that took me back to 2000, so 22 years. It's never dropped 6 consecutive months in those 22 years. All records are meant to be broken. This one will too, I'm sure. But the point is, we've gone from 9.1% in July to 6.5% in December. That's almost a third. That's more than a third of the way back to the Fed's target range of 2%. And they could continue to incrementally raise rates until they see a crack in the jobs market, a visible one, or a crack in the economy. That doesn't seem to me like what they're going to do. The idea of knowing there's a delayed impact on raising rates, I think the delayed impact could go either way. So I don't think they want to go too far. We get the PCE, the core PCE price index on Friday. That's the Fed's preferred measure of inflation. The last couple of months, that one's come in up 0.2%. This month, it's expected to be up 0.3. So I suspect the Fed, like everyone else, is looking for up 0.3. Maybe they tolerate up 4. I think if it were up 0.5 or more, for sure more, we could see another 50 basis point rate hike. But absent that, I think everyone says it's going to be 25 next month, and so we'll then be at what, 475. Then we have a meeting on March 22nd. Between now and then, we've got two CPI reports. We've got 2 jobs reports. We got 1 more PCE report. And I think the upcoming PCE report Friday could push them to a 50% hike, but otherwise it's probably 25. I think the other reports I mentioned will probably dictate whether in March we're seeing Fed funds at 5 or 5.25. And the meeting after that is May 2nd. So So whether the simple question to where I think funds stop is, I would say 5.25 plus or minus a quarter, and I would say it's going to be in March or May 2nd, March 22nd or May 3rd, I think it is. I think that's where we get to. Now, is it a top? It's a pause. My guess is once they pause, and as long as we don't get alarming inflation news or alarming jobs news in the other direction, I think once they pause, it's for quite a long time. I've looked forward where the meetings are. I can't imagine even that the September meeting, we would see another hike once they pause. And I surely don't see pivots coming anytime soon, absent a meltdown. So going forward, I think we're going to see Fed funds at about 4.25, give or take a quarter. I think they'll hold there for a long time, could be throughout the rest of the year. One thing I have seen that could impact things, and this is well above my pay grade, but I've read smarter people than myself that think that CPI, as it comes back down, could get stuck around 4%. The Fed wants it at 2%. I think it's probably an intriguing debate as to if CPI comes down to 4% and stays there, does that mean the Fed will have to start raising rates again? I think all of this about a top and where it ends, that's a different discussion. And I think when they pause, that pause will probably carry us into next year. So I say 5.25.
Do you, so the interest rate picture is kind of one part of our industry and doing business in general. I wanted to ask, I wanted to come back to you, Max, because you deal, you mentioned earlier, or maybe Carl mentioned, dealing with 5,000 brokers across the nation. You think, oh my gosh, 5,000 brokers, holy smokes, are there even 5,000 brokers? Well, sure there are. That only averages out to about 100 a state. And there are plenty more than that in, say, places like California or Texas or Florida. Max, when you are dealing with a new broker who's potentially doing business with A&D, what are the key attributes that you as a wholesaler look at in terms of broker approval? What is it? What's a good broker versus a bad broker? What does it take to do business with you guys? And if you were to give a broker advice in terms of their business, what would it be?
Well, it's not that complicated to do business with us. Our approval criteria is not complex. And the way you get signed up is we have a specific form online and you fill it out within, 5 minutes approximately, and you get approval in 1 day. So the whole startup is easy. We have a whole situation where we have preferred broker program, and more loans you close and better your pull-through ratio, the faster your loan goes through the system. But our loans go fast through the system anyway, so we have a completely new redesigned technology where loans close. Lately our average loan close, non-QM loans, if all the docs in, closes within 12 to 14 days, which it's very, very different from everyone else. But what advice for new brokers that we have is to, hey, right now is difficult times where there are less buyers and it's a little more complicated to get somebody in where they just a year ago wanted to get a 2.5 to 3% interest rate, and today they have to be around 7% for conforming, 8% for non-QM. That's a little bit of a pain, and it's not that easy. So we offer a lot of different things to our partners, as we have AD Studio, where there's a bunch of marketing and explanation and videos and tools that they can use. They can take it and post this in Facebook and LinkedIn. There's a lot of design that we give our partners for free. We also have webinars. Where is the webinar where we tell people how to spot these non-QM loans and what exactly we can what we can do, how to use our tools. And we actually, our guys are talking about not only A&D, they're talking about the whole industry, how to use everybody's tools. What is it you have to look for? But the most important things for brokers today is not to lose clients. If you have a customer and he wants to buy a house and he's willing to be in higher interest rate environment that is unfortunately we are in today, you have to find a way how to make this happen. You will make the person happy right now by getting his family in the house, and you'll have a client to refinance later, because no matter what happens now and how high the rates are going to get, there will be time when the rates are going to start coming down, and you can reach out to this borrower and say, hey, remember we have, I think you have paid 8%, it's 4% now. Why don't we refinance your home now? So what we're trying to do, Rob, the most important thing is trying to show our partners how not to lose these borrowers that can be actually, done given the non-QM asset depletion alternative ways of looking at income.
That's good to know. So have you seen, you mentioned a statistic earlier, Max, that I wanted you to elaborate on a little bit. You said you were closing loans in 12 to 14 days. Is that unusual? Is that something?
It is unusual. It is unusual for non-QM. Yes, it is. Non-QM world does not close loans in 12 to 14 days. We close all loans in 12 to 14 days. Either it's conventional FHA or non-QM. But for non-QM, it's unusual. You can close conventional loan with. We have a lot of our great competitors who do it super fast, but it's practically impossible to close non-QM loan that quick as fast as we do.
Well, that's very, very commendable. So congratulations on that. Switching gears a little bit though, and Alex, we're not going to talk about short-term rentals again, but I think that, as I mentioned earlier, A&D offers a variety of programs with different rates, different pricing, different rate lock terms, et cetera, et cetera, et cetera. I think brokers want to know how is pricing set? How do you set prices out there for the products that you offer?
When we're creating our pricing, there are two main companies which we're focusing on. The first one would be market execution, which is priced out of the securitization execution on today's market. Non-QM product on average has 3 to 5 year duration, and non-QM rates are highly dependent on that short part of the yield curve. So all securitizations are priced to treasury today, so that would be a 3 to 5 year treasury bonds that we are pricing to. Also, this is obviously layered with a number of default probabilities that are assigned by rating agencies for each in particular loan due to its credit criteria. So with a combination of the execution, and the second part is actually competition. And when I say competition, we in our research department are closely monitoring the whole market to make sure our rates as well as our affordability as far as guidelines and eligibility of the product remains best and very competitive and very competitively priced on the market. So securitization and competition is the two main factors that we focus on creating our pricing. As well as when the loan is in the process, as Max has mentioned, for the closed loans, we're very focused on having our servicing in-house, right? So we provide the best service borrowers and brokers, that your borrower doesn't have all this headache with the loan being transferred from one servicer to another, and borrower doesn't know where they pay to. The same as the same thing we have for the loans in process and the pipeline, with the interest rates moving in the borrower's way. Basically, if the interest rates drop, we have our lock policy, which allows broker to flow down the rate and have their pricing always up to date on the market.
So you mentioned I'm gonna go down the rabbit hole a little bit here with you with a follow-up question. You mentioned rating agencies, and if you go back to 2008, 2009, a certain amount of the blame of the financial crisis or Great Recession or whatever you would like to call it was placed on the rating agencies and their inability to truly gauge the risk of mortgage-backed securities. I'm not going to ask you what changes they've made, but do you feel at this point that brokers understand what rating agencies look at in terms of credit? And if so, or if not, can you at least explain what the audience should clue in on? Just a basic, 1 or 2 paragraph bit about what rating agencies look at when they are looking at a particular bond.
Yeah, absolutely. So I think that education to brokers from rating agencies kind of fall on the lenders, as we as the lenders get feedback from rating agencies on what products and what LTVs, credit scores are acceptable and what not, what income types are acceptable or what not. And that being said, since 2008, for example, rating agencies do not want to work with any no income documentation for owner occupied loans, right? And we see that in line with the CFPB requirements as well. DSCR, very low DSCR ratios is being a concern for the community, because normally investors and rating agencies want to see the ability for the property to pay for itself, or at least have a little higher equity participation in there, which we have in our programs to kind of support the properties with a little lower ratio than one with an additional equity.
Okay, good to know. And then obviously rating agencies don't predict where interest rates are going to go. So I'm going to turn this back over to Billy. Not so much an interest rate prediction, although kind of an interest rate prediction. And Billy, I'm hoping that you can tell the audience about why, say, 30-year mortgage rates have done what they've done over the last 3 or 4 months, and any thoughts on what brokers should be paying attention to in terms of economic news, which might drive 30-year rates in the future to go up or down.
Well, Rob, if I have an expertise, it's more on reading charts than on the whys of what the market does. But that having been said, obviously, the simple answer to what mortgage rates are going to do is they're going to track a blend of the 10 and 5-year treasuries, and so to me, you want to start with where the treasury market's headed, and then of course mortgages traded a spread to treasuries. Unforeseeable events that cause a flight to quality can cause those spreads to widen out dramatically. I happen to think we're in a cycle now of where we'll see the spreads narrow. And I think, again, barring something unforeseen, I think that's because with the reduction in housing production, in mortgage production, you got a reduction in mortgage-backed securities. And there's a lot of big investors that hedge funds that do little more than invest in mortgage-related product. Less production, less mortgage-backed securities, tighter spreads. So I think in terms of where interest rates are probably headed and what we can look forward to, it's kind of good news and bad news in my opinion. I think the moves the all-time low yields were printed in the summer of 2020, thanks to COVID. 5-year got to 19 basis points, I think. Since then, it's printed 450 last October. It's kind of it's an unprecedented move up in yields. So a little over 2 years, up 450 basis points nearly. The way I look at the charts, I see this move as possibly completed, if not very mature, probably 90 to 95% of the way through. I think if there's a higher yield than what we saw in October, which was a 455 year, I think it comes by the spring. And so I'm sitting there debating, working each day, trying to figure out which is more likely. But past the minutia, okay? So we're talking about a treasury yield that mortgages will pay attention to that's going to have risen for 2.5 years, let's say, 450 or more basis points, not much more, I don't think. And when that finishes, I said early on, good news, bad news. The bad news is the interest rates dropped for 40 years almost. I think reality is that COVID put an end to that bull market. And I think going forward, it'll be a bear market for a while. But the bull market had a whole lot of bad times, and the bear market will have a lot of good times. So what I think we're about to see is if the 450 top in the 5-year in October was not the end of that move, I suspect something south of 5% within the next couple of months will be, surely by the springtime. And then I look for extended corrections, 2.5 years up, anywhere from 1 to probably you'd say 2.5 years back down in yields, give or take. And in any markets, you would expect big moves to be retraced at least 50%. So that means 250 basis point recovery over a span of a year and a half, 2 years. So you could be talking a 5-year back around 2.5%. This year might be a stretch, but next year's not at all, in my opinion. And in fact, some of the work that I do, I rely on a lot of things. One of them is Elliott Wave. I mean, that would suggest that when this first push is over, we recover more than half of it. That's exactly what happened back in 1981 when a bear market turned into a bull market. The first 4 or 5 years saw the 5-year go from 16.5% down to 6.5%. It didn't stay there. It gave back more than half of that. But then when it started to rally again, think about that. It rallied from 16.5 to 6.5 in the first 4 or 5 years. It took the next 35 years for it to go another 6 basis points down to near zero. So I think what we are here is we're looking at an extreme caused by a perfect storm. COVID pushed interest rates to ridiculous levels. Fed tried to provide liquidity. Maybe they provided too much over the years. We run into this inflation buzzsaw. Bottom line is, I think the 5-year go back to about 250. Now I turn around and look at mortgage rates. Bloomberg, you can produce a chart on Bloomberg that is the implied yield of a par TBA. And if you do that, you then get a consistent chart as far back as you can look of theoretical mortgage yields. So in other words, if you're looking at a coupon, they keep changing coupons, you don't have history. I look at that chart, and there was in August of last year, mortgage rates had come down and they bottomed out at about 3.5%. And then they accelerated back up dramatically. And that 3.5% number looks like a pretty good target on any pullback. Now, again, that is for a par TBA. That's not a mortgage, but go a little bit further on this. Yield spreads of treasuries to the of mortgages to the 10-year, and it would be that same kind of a mortgage yield. They topped out at about 190 basis points in October, same time the market rolled over and started to rally. And during this rally, they've gone from 190 to about 130 basis points. And if you look back where they were, say 2 years ago, there was a lot of time spent consolidation with those spreads at about 75 to 85 basis points. So if the 5-year can get back to 250 and those yield spreads get back to 75 to 85 basis points, that also points us to about a 3.5% roughly theoretical par TBA. One more thing to consider, and that is that if you look historically at that same chart, 2020 at the bottom, that theoretical 30-year mortgage TBA yield was about 1.5, 1.25. And in October of last year, it was about 6.25. So it moved 500 basis points. Half of that's 250. That brings you back down to 350, 375. So now the last thing you do is you say, if we can look at a TBA, implied yield of a TBA at 350 or 375, where's the mortgage rate? 30-year mortgage rate puts it at about 4%. And then I'll go right back and say what I said about the 5-year. Reality is this particular rally, which in my mind is the first rally after the first break in a bear market, really should go deeper than happened. So I see mortgage rates personally going back into the 3s. Is it this year or is it next year? I don't know. I would say this: it's if it isn't this year, I think the move has started this year, and will be well underway as we move into the last quarter, and it may move into next year. We'll see. So I look for better days, and then here's the last silver lining I'll give you. Again, if it's true that this is a bear market, and bear markets are full of rallies, but from a broker's perspective, it's unlike the 39 years that preceded the bottom. The longer anybody waited to take out a mortgage, typically the lower the rate got. I think that table's turned. I think it's time for brokers to talk to their investor customers and let them know the longer they wait on a mortgage, the higher the rate may be. And so I look forward to a pretty good next year, let's say. It could be 18 months. And then we'll probably go through other times like this. And the last thing is that I think sticker shock affects the borrower more than anything else. I don't think there are levels that people will get used to and borrow money. That was the way from 16.5% down to a half, and it'll be the way back up. And by the way, I don't think we'll go back to 60%, but I just think we're in a period where we're not going back to 20 basis points in the 5-year. So.
Yeah. All right. Well, that's a very thorough answer. Thank you very much. Yeah. Anybody, it's good to have a battle plan, but battle plans are good until the first shot is fired, as they say. So, but that's a great amount of logical thinking about, and a good way to think about interest rates in general. I know we only have about 7 or 8 minutes left. I wanted to return to Derek, the social media master who knows how to even spell LinkedIn, so that whether that's a capital I or a small I in LinkedIn. But Derek, what should brokers know about social media in terms of using it to their best ability? What services can A&D offer through you or with you that will help brokers expand their reach and expand their market share and so on?
Thank you, Rob. To quickly answer your question, the easiest way to understand social media in general is it is a tool to position a broker's business, a broker's brand, a broker's products or services or solutions that they provide. It's a tool that they can use to build their reputation towards their target audience, and it's a communication tool that they can use to get the conversation started. Now, the best online platforms or social media platforms for brokers are basically LinkedIn, Facebook, and Instagram. And all 3 of those operate very differently. And that's what I help brokers with is how to understand the differences between those platforms and how they can use them accordingly.
Do you have without stealing your secret sauce, do you have a synopsis, a summary of the differences between those 3 that
Sure.
you could tell us today?
Sure. LinkedIn is basically when somebody is interested in a loan of whatever type. Okay, so they're going to go to Google in many cases, and they're going to search for a broker, okay, in their area who can provide them the loan that they're looking for. So when they see people's names come up on Google, for example, or they might have even been referred, one of the places they are going to look, those prospects are going to look to find out more about that broker or the brokers that they've come across is LinkedIn. Okay, so LinkedIn is great for positioning the broker and how they present themselves towards their audience, the solutions that they offer. Okay, LinkedIn is also great for B2B, so it's great for reaching out to other people and building up those relationships, building up those referral partnerships, etc. Facebook, who also owns Instagram, is the most targeted advertising platform on the planet, bar none. Okay, and so what that means is if you're a broker and you're looking at advertising and reaching people who have a specific need for loans right now, okay, then Instagram and Facebook is the advertising platform that you use. Now, really importantly, let's say a broker puts up an ad on Facebook, okay, and somebody clicks on that ad. They want to know more about what that broker offers. Then obviously they're going to look into that broker. And so the question becomes, what are they going to see? E.g., their Facebook page, their LinkedIn profile, etc. What is that prospect going to see that's going to entice that prospect to want to know more, to ultimately want to reach out and talk to that very broker?
Okay, good. Well, thank you very much. That's good. I think if I were a broker and had signed up with A&D Mortgage, your services would be very valuable because the billboard by the side of the road may not be the best advertising medium right now, and brokers who don't use the technology tools that are available to them, they're losing business, plain and simple. So thank you for that. Somebody texted me a question while we were on the show here. They may not have put it into the group questions, and I know we've only got a couple minutes here left, but the question was with regard to technology and technology for brokers, and Max, I'm going to direct this to you. What technology tools do you think brokers should use or are using that you've seen are most effective, especially in dealing with non-QM loans? Max, you're muted.
Yes, I'm sorry. Historically, guys, non-QM business were lagging the technology is because every technology been used by conventional guys, and they kind of took the full usage of everything there was, and non-QM was not actually using any technology, right? Because the lenders, who our competitors, did not have enough horsepower or enough engines to do that. Now what we see, the trend is where brokers demand technology in non-QM. So we were doing a lot of different things. We have an internal OCR and doc recognition and automated underwriting. It's not working on all 100%, but it's working on the big part of it. We have auto conditions are popping up there to help underwriters. We have new broker portal. We launching in 2 months. We're launching even new and updated broker portal, which will be interactive and will give a lot of notification and communication messages and a lot of different things. So we believe that the technology is coming to non-QM world, and it's going to get closer to conforming. And brokers, once they choose their partner who they're working with, have to see who is direct market connector, who has the ability to do their own securities, because it's been pretty tough last year. So the only people who were able to maintain the program, maintain the rates, and maintain the relationship are the guys who have direct access to the market. Everyone else who were trying to resell the non-QM loans were not able to maintain the business, were not able to maintain the relationship with partners. And of course, everybody who invests in the technology. We invest a lot. This is the biggest part of our spending, and we understand that every big lender at the moment is scared of investing and don't want to pull the money in, trying to preserve the money for everything else. We have completely different opinion. We investing more and more in technology. We believe that's the future. You have to have a big broker infrastructure. You have to have your own development, and all the softwares that A&D uses, it's our own development. It's origination software. It's all the OCRs. It's DUC systems. It's servicing software. We own the code on 100% of our systems, so, which is really important.
Very convincing.
Rob, we did have one other question come through. Let me post it up here from Dustin. So let me put it up on screen. It's not posting on screen. Basically, since we'll probably never see rates in the 1s and 2s again in the foreseeable future, do we see that there'll be a need for cash out or rate and term revise?
Is that open to the group, or
yeah,
directed at Billy or Alex?
It can be open to the group.
I can start this for 1 second. We do believe there always will be a cash out. If somebody needs to consolidate and pay off something, there's always a cash out, and rates will start coming down sooner or later. It's not that the rates is going to continue to be like that. We never know. We might see low rates again. You never say never, but you know, the rates are high. They will be starting coming down end of this year, next year. Even Fed projecting the rates are starting to come down. So cash out always there. This doesn't make sense probably to cash out the loan to pay off the loan that you have for 2 or 3% and get a little money out, but you can get a second mortgage out, which we are launching in, I think in 30 days, we are launching a second liens with non-QM income verification. So we think it's going to be a huge boom, but we'll start marketing this in a couple of weeks. But we believe there always be cash out no matter what interest rate are. Alex, go ahead.
Yeah, I think Max was right on point with that, and there's a few things to add. That rates are high right now, and with Fed starting to decreasing the terminal rate, right, the Fed funds rate, we will see those going down, and the current production of 2022 and 2023 would be refinanceable. That is also part of the overall originations out there on the market, which would be refinanceable, and Billy can add to it as far as what is the potential maybe for the rate drop and the refinance incentive that may be there.
Yeah, and my take is this: that you know, first of all, yeah, are we going back to 1%, below 1%? Probably not. But let me say it differently. Hopefully not. It took COVID to get yields where they got to. I think that we're going to get into an orderly market where we go through periods of rising interest rates followed by periods of falling interest rates. There'll always be refi business. I think the floor, as I tried to say, could be lower than I'm willing to stick my neck out. I don't think the 5 years is going to see 19 basis points. I hope the 5 years not going back to 19 basis points. I hope that disaster isn't pending. But I think we're going to see rates lower than most people believe. And I think once if the current top's not in, it's coming soon. And I think we're going through multi-years of improvement, though not wanting to stick my neck out too far. But I really do. I think we'll spend more time improving and seeing rates come down going forward than going up. I just think over the next 10, 15 years, you may see a series of higher peaks and higher valleys in terms of yields.
So you work with a lot of doctors, lawyers, small to medium-sized business owners, independent financial advisors.
Anyone else?
All right. Well, Carl, I'm going to turn this over to you. We've run a few minutes over, but understandably so. Any last wrap-up comments that you'd like to make?
Carl, I don't hear you there.
Carl there?
Carl is here. He's got it on mute. I keep telling everybody not to mute theirs. Yeah, so there are a few good reasons. Thanks, Rob. Thanks for great hosting. Thanks for our panelists. So a few good reasons that we've talked about and talked around it. We have a very streamlined loan process. We're very customer service oriented. We have a lot of flexible loan solutions for people, both in terms of what we offer and in the underwriting. And to pick back up on something that Max had talked about earlier in terms of webinars, just to let people know of some of the other ones we've got coming up in the next couple of weeks. Each month we do a new broker orientation. So this is a way that we help onboard newly approved brokers on all of the services and tools and technology that we have. So we're always coming up with something new. So if you've attended one in the past, it can't hurt to have a refresher. Then we're going to do a deep dive in a month on conventional and government loans. In part because, as Max has said, we're extremely well known as a non-QM lender, but we would like to remind people that we also are an excellent conventional lender, given the turn times that we were discussing earlier. And then towards the end of March, we're going to do another co-hosted webinar looking at the spring housing market with Rick Sharga from Adam Research. So if people want to start signing up for these, there'll be some links coming to you after this. We'll also send her a copy of the recorded video. And that's all I have for everybody. So thank you for a really interesting discussion. I think it was what we hoped everyone wanted it to be. So thank you, everybody. Thank you, Rob. Thank you, Max, Alex, Billy, Derek. Derek, you and I will be getting in touch about the possibility of doing a super deep dive in social media marketing. So you and I will touch base in a couple days here. Cool.
All right. Thank you very much, guys.
All right.
It's very nice to be with such a nice team. Thank you, guys.
Thanks, everybody.
Thank you, everyone.
Thank you, everybody. And
Bye.
a pleasure to meet everybody.
Likewise, Derek. Thanks.